Yeah, certainly. And I think that this is, when we talk about giving the best advice possible to people in terms of building a portfolio and investing, I think that this is a big part of it. And where are you going to put your capital? There's always a bias. There's always a home bias wherever you are, whether the United States, Europe, Canada. There's a bias towards investing it in your own country. And in some cases, there's reasons for that. But particularly for Canadians, there are strong reasons to look outside of the border and down to our neighbors to the south. So this is basically what we're going to talk about: is as a Canadian, should you just keep your capital at home or should you invest in U.S. stocks? Now, the United States has been a serial outperformer of Canada for almost all of the last decade. If we look over the past 10 years, in 8 out of 10 years, the US market has outperformed the Canadian market. So this is S&P 500 versus TSX Composite Index. Outperformed in 8 out of 10 years, but outperformed by a very large margin. So this chart here really just illustrates it every year, the excess return of the S&P 500 over the TSX Composite Index. So this is excess return. This is what it's producing in addition to whatever the TSX produced. So only 2 years here where the TSX outperformed, the most recent one being in 2022. What was the reason for that? Well, in 2022, energy had a very strong showing in the stock market, whereas technology had one of its worst years since the financial crisis in 2008, 2009. So this was the reason for 2022. Now, this outperformance has actually continued in 2023. So although Canada outperformed last year, don't get your hopes up, Canadians, that this is going to be the start of a new trend. Looking at the performance of the S&P versus TSX year to date, S&P is up almost 19% compared to the TSX's 4%. So, back again on another year of what's likely going to be a strong showing for the U.S. market versus Canada. So clearly, any Canadian investors who have not taken part in the U.S. market have missed out on a lot of return over the past decade, including in the current year. Return that they could have had if they had some form of allocation outside of Canada and into the US. Now, this is all historical information, of course, and we never want to just extrapolate historical information into the future and assume that this is going to continue to be true, assume that the United States is going to continue to outperform Canada by a strong margin over the next decade. However, there are some reasons why I believe that this is a structural problem for the Canadian market and why this outperformance will continue in the US, and therefore why Canadians need to look to the US market for at least a portion of their capital. So I'm going to illustrate that on the next couple slides, what this problem is. This slide here, this is the Canadian stock market sector weighting. So the Canadian stock market by sector. Um, we're basically looking at 8 sectors: financials, resource, industrials, technology, consumers, utilities, communication, and real estate. And what we're seeing here is a very high concentration in the Canadian stock market to just 2 sectors, namely financials and resources. Now, resources, this is primarily oil and gas, mining. So these are cyclical companies. Long term, they do not generally perform well, a lot of volatility. And then financials, well, over half of this sector is just the big 6 Canadian banks, right? So there's a major over concentration into just a couple of sectors here on the Canadian market. But perhaps less obvious is, well, one, that even this over concentration is underestimated because a lot of the industrial companies, industrials being the third largest sector, um, weighting at about 13% of the Canadian stock market, a lot of those service the resource industry. So we have about 30% of the market in financials, most of that the big banks, 30% in resource, which is primarily highly cyclical, volatile companies, commodity price driven companies, and then a good portion of the industrials. So over 60% really in these 2 sectors. Less obvious is where we're under represented, and that is in the technology sector. Now, here we have technology at 8% of the Canadian stock market. But in reality, that's really kind of an overestimate in some ways, or at least if you look deeper and figure out like what our technology sector is comprised of. Because Shopify is a major percentage of the sector. I actually don't have the number right now, but generally, like around half of our technology sector is in just one company. So, uh, underexposed to technology. Um, Overexposed to two other sectors. Now, let's take a look at the US stock market by comparison. And right up at the top of the list, we have technology, almost 38%, about 28% of the US stock market. Again, this is actually probably an underrepresentation because some of the companies, some of the major companies may not necessarily be classified in the technology sector. Companies that are technology driven that we would consider to be technology companies. Apple is sometimes classified as a consumer product. Amazon can often be classified that way as well. But regardless, technology is the most important sector in the U.S. stock market by far. And then beyond technology, we just see a better diversification across the different sector groups in the U.S. market. So number two is consumer at 17%. Number three is healthcare at 13%. Now, we essentially don't really have much of a healthcare sector in Canada, which makes sense because we have single payer healthcare up here. So it's a completely different structure. But the US at least provides an opportunity to invest in that space. So, really, technology being up at the top of the list is one of the most important things because when we look at the way the world is evolving, so much of this, I mean, it's really all being driven by innovation, or so much of it is being driven by innovation. Innovation which is created by the technology sector, but doesn't necessarily just influence that sector. It's really influencing all sectors. So if we just look at artificial intelligence, which is the major theme in technology right now, or cloud computing, another major theme in technology, these technologies come from the technology sector, but really they're used to make all sectors more efficient, and create opportunities across the entire market, across the entire economy. So for us, technology is one of the most exciting sectors to invest in, and it's unfortunate that it just really is has a minimal presence in the Canadian stock market. Now, going back to the outperformance of the US stock market versus Canada, when we talk to Canadian investors, probably the most common reason that we hear from them why they do not wish to invest in the US stock market is because they're concerned about the currency exchange risk. When you're invested in US stocks, you're going to have exposure to US currency. That's a concern. They see that as a source of risk. Now, we don't believe that that should dissuade somebody from having an allocation to the US. Now, once again, we're talking about an allocation, not all of your capital, just a portion of your capital. First of all, the US currency is the most important currency in the world. So having some exposure to it is probably good for your portfolio for diversification purposes. But even beyond that, we really think that for long-term investors, the currency exchange risk is really going to even out over time. In some years, it's going to help you. In other years, it's going to hurt you. But it's really going to even out over time. So it's not something that we would be concerned about, overly concerned about. There are ways to hedge the currency risk. We don't necessarily advise that for most retail investors, but there are ways to do it. But really, we think that it is not a good reason to avoid investing in U.S. stocks. So I'm going to pull up the outperformance data again over the last 10 years, over the last decade, from 2013 to 2022. We have another chart here. So these blue bars, that's just the chart that we saw a couple slides ago. This is the outperformance of the S&P 500 versus the TSX. But these orange bars, this is the outperformance in terms of the nominal price change of the S&P 500, and in addition to the currency as well. So whatever you would have gained or lost in the stock market, plus whatever you would have gained and lost by having exposure to US currency. And what we're seeing here is that for the most part, things tend to even out. You actually would have been much further ahead by investing in the US currency over this period of time. But even putting that aside, in 5 out of the 10 years, the US currency actually helped you. It actually gave you additional return beyond what the S&P 500 did. and in the other 5 years, it went against you. Um, but in only 2 out of the 10 years did it actually take an outperformance of the S&P 500 and turn that into an underperformance. There was really only 2 years, and that was in 2016 and 2018. So last year, even though the Canadian stock market outperformed the US stock market by about 11%, um, it really actually turned out to be only about 4% after we consider currency exchange risk. So even in years where the currency worked against you, you still were better off in almost every year to invest in the US. So we don't want to, again, extrapolate that this is what's going to happen going forward. Um, Really, the point is to just drive home that not wanting to avoid the currency risk is not a reason to avoid having a portion of your capital in the US. That's just good diversification. Furthermore, the diversification and breadth of opportunities in the US is far greater than it is in Canada. There are types of companies you can invest in that you just don't have access to in Canada. So these are good reasons to look south of the border for some of your capital. Now, the question then is, how much of your capital should you allocate to the US market? This isn't really a question that we can answer because it really depends on so many investor specific factors. I did provide a couple of guidelines. These are really just guidelines examples, but I would say for minimal allocation, the absolute minimum that really any Canadian should look to have exposed to the US would be about 15% of their portfolio. I think that's a fairly minimal amount, but it does give you some allocation down there. A more moderate or mid-range amount would be about, 25-30% of your portfolio. And then if you wanted to get more aggressive and have more exposure to the US, for some people, you could have 50%, even 60% focused on the US. And in some cases, even more. But that really just comes down to a lot of investor specific factors. And that's not a question that we can there's no one answer to that question that's going to apply to everybody. So that's something that people have to figure out for themselves. What is important, though, is that the allocation be greater than zero and that investors not be dissuaded by the prospect of currency exchange risk.